Today we'll be looking at a new IRS rule that could dramatically increase your business tax burden if you're not prepared. As a registered CPA and owner of a tax technology company, TaxElm, I've never seen an IRS rule change that could impact many businesses' bottom lines so significantly. That's exactly why I'm making this video today, to show you exactly what this new rule means for your business and how to protect yourself from unnecessary tax exposure. Let's get right into it. So the rule that we're talking about today is this 1099-K rule. And this is something that the government put out many years ago, and it just keeps getting pushed over. And so to start with, I just want to talk about what is a 1099-K. Basically, a 1099-K is a form that you receive that shows how much money you received from a payment processor. Now, that could be PayPal, Cash App, Venmo, maybe Stripe, or something like that. But basically, a 1099-K is a document that payment processor sends to the IRS that says, this recipient, we sent X amount of dollars, we processed X amount of funds for this recipient over the course of the year. They send it to the IRS, and they send that to you. And so when you receive that 1099-K, that means that the IRS also received that 1099-K. And so it's important to make sure that everything on that 1099-K also matches what you're reporting on your tax return. Because if you receive a 1099-K for $30,000, and you report on your tax return that you had sales of $10,000, well, guess what? The IRS is going to be dinging. Their red lights are going to be dinging and saying, hey, we're showing that they have $30,000 in sales. They're only showing 10. That's an immediate reaction. So the 1099-K is really a tool that's used to let the IRS know what funds are being processed and who's receiving those funds. And there's other 1099s like a 1099 NEC or a 1099 miscellaneous. And that is the sole purpose, to help the government understand who's receiving income and from who they're receiving that income from. So what is this rule? What is the old rule? What is the rule that changed? And basically the rule that changed is the rule used to say that if payment processors, again, think of Venmo, PayPal, Cash App, maybe Stripe, a credit card processor. If you're processing credit cards, there's a payment processor there. But previously, payment processors would need to be sent a 1099-K if they sent you $20,000 over the course of a year or over 200 transactions over the course of the year. So that's the old rule, that 1099-K needed to be sent if the total processing amount over the course of the year was $20,000 or more, or there was over 200 transactions. So what is this new rule? What is changing from that $20,000 limit? So a couple of years ago, the government changed that limit from $20,000 down to $600. That's a dramatic change. So now any payment processor, if there is income of over $600 that they process, they paid to you, there would be a requirement, a 1099-K requirement. $20,000 down to $600. So as you can imagine, there was big pushback on this, because not only is that just an administrative headache where all these payment processors now have to do 1099-Ks for someone making $1,100, there's a big administrative headache. There's also push on different things that we're going to talk about, that $600 limit and what qualifies as a payment processor. So a couple years ago, the government moved it from $20,000 to $600. But because of that big pushback that the government was receiving, they've been delaying that. And so every year, there's words that this is going to come into practice now, and then it gets delayed another year. But now we're coming to fruition. And so back in November 26th of 2024, this year, there was the IRS came out and said they're going to slowly start to transition this rule into place. And so that slow transition means that for 2024, tax year 2024, that limit, instead of being $20,000, is $5,000. And in 2025, that limit, instead of being $20,000, is going to be $2,500. And in 2026, that's when the actual rule of $600 is going to come into play. So let me repeat that again. The old rule is that if a payment processor sent you $20,000 or more, then they had to send a 1099-K. If it was under $20,000, they didn't have to. The government put a rule in that changed that $20,000 limit to $600, but due to pushback, that rule has continued to have been delayed. And now an announcement on November 26th of 2024 said they're going to start to slowly transition this. Tax year 2024, that number that payment processors would need to send you a 1099-K for is if the total processing through the year was $5,000 or more. And then starting in 2025, that number goes down to $2,500 or more. And then starting in 2026, that number will be $600. Now, I make this a quick disclaimer that all of this could change. Because this continues to get pushed off, changes continue to be applied, all of this can change, but that is the most recent update we received in November, at the end of November of 2024. 2024 number, 5,000, 2025 number, 2,500, and 2026 number 600. Now, the key thing to note about this is that this really only applies to money received for goods and services through business accounts, not personal payments like splitting dinner bills with friends and like that. So that is one thing that we always want to think about. The other thing I want to talk about is that this is a reporting requirement change only. Now, people might be saying, well, really, what does this change? Well, the problem is a lot of people were not reporting income. So traditionally, if you're receiving income for goods or services you're performing, you're required to report that as income on your tax return, regardless of if you receive a 1099 or not. So if you get a 1099, you report it as income. If you don't get a 1099, you're going to report it as income. The problem is some people don't report as income unless they get a 1099, and that's illegal. So from a tax aspect, not much change from this. This is just a reporting requirement change. When is that payment processor required to send a 1099-K? That's the major change, but I want to make it very clear that you should always be reporting all of your income, whether you receive a 1099 or not. So let's talk about who does this new rule impact. Basically anyone who accepts payments through apps like Venmo, PayPal, Cash App, Stripe for goods and services through business accounts are going to be now receiving a 1099-K, even if it's, they're processing, 2024, $6,000 or $5,000 or more. So think of online sellers, small shops, think of freelancers and gig workers, think of various different service providers or small business owners. That's who this rule is going to affect and come into play for them. Now, since we can only cover what this rule is in a small amount of time here, I don't want you to leave this video and fall into content trap, where you become so wrapped up in generalized advice that you never take action. Especially with year end right around the corner, it's really important you don't lose out to the IRS. So to help you out right now, I want to offer you an entirely free demo call where we'll look at your exact situation and help you come up with a game plan for your taxes. Click the link below to book a video demo call with our team. All right, so let's talk about the why. Why was this rule specifically put in place? What's kind of the basis of it? Where did this come from? The main reason is that people were underreporting income. Think of someone like a hairdresser or maybe a childcare provider where they're getting these Venmo payments, they're accepting these payments, but they're not reporting it as income on their tax return because they're not getting a 1099. That's what the government's coming in. The government has always said, if you earn income, you got to report it. But guess what? Some people weren't. And that's what they're trying to resolve by moving that $20,000 threshold down. They're hoping that will then cause more people to force report their income. And so everyone's kind of experienced that. You pay someone on via Venmo for childcare and, it's childcare, but you put in their balloons to say it's for something else, or happy birthday, even though it's for taking care of your child or something like that. And that's what the IRS is trying to get around. And that's why this rule ultimately has come into play. So let's talk about why could this cost business thousands? How can this really affect your business? Well, from a tax perspective, as I mentioned, it shouldn't affect anything because you should be reporting this income anyways. But for those of you that are trying to cheat the system, if you haven't been reporting all of your business income, you'll soon get that cloak torn right off of you because this is going to change that. So what I would say, first off, follow the rules, follow the law. If you receive income, you got to report it anyway. So for most people that are following the rules, doing things the right way, this change doesn't make much of an effect to them. Now, you might need to hire an accountant or a tax professional to handle the new reporting requirements and ensure compliance, which could add some cost to your business operations and various things like that. But remember, this is income that we should be doing anyways. The other thing that could cost is we always recommend that you want to have accurate set of financials because what you report on your tax return, the IRS is going to match that up to what they're receiving on these new 1099-Ks that are going to be coming out. You want to always make sure that is accurate. So you want to have a solid bookkeeping system and software that's going to track those incoming payments that are coming in. And you want to make sure that system is set up separately from personal transactions. So when you start to commingle stuff, that's going to really kind of throw a wrench into this idea on having accurate reporting. So it's especially going to be important, especially after this new rule comes in, that you have a solid bookkeeping system. You have that separation of personal expenses from business expenses, and you have that all nicely, neatly done. So, of course, there's going to be some added cost there. Make sure you have a solid bookkeeping system. Maybe you're bringing out a bookkeeper, whatever it might be, but there's some legwork that you might want to do there. Now, some of the concerns regarding this rule was, if we're targeting Venmo or Cash App or Zelle or these different things, what happens if I buy tickets to a concert for a group of friends? Like I'm in that, we've all been there before, at least I've been in there before, where you get the pre-order link to a concert that you really want to see, and you say, okay, talk to all our friends. Okay, I need to buy 8 tickets. So I'm going to go in there and buy 8 tickets. They're all priced at $800. So I'm buying 8 tickets for 8 friends at $800. And then my friends, of course, are going to pay me back that money because I'm going to buy the tickets because you buy them all as a group, but then our friends pay us back for those tickets. Or maybe you go to a lunch with friends or a dinner with family and you say, okay, I'm just going to put this on my credit card. You guys all just Venmo me the number. There is some concerns that this rule could start to affect that, where because you're setting that $600 limit so low, especially starting in 2026, that $600 limit, if I buy an $800 concert ticket, that one person paying me back for that $800 concert ticket is right away wiping out and requiring that 1099K. Now, the thing with this is that this is only supposed to go in effect for business accounts. How that works, we don't know. We're going to have to wait and see kind of how that is treated from Venmo. Like when you have a personal account, is Venmo going to look at those transactions? How is Venmo going to distinguish personal versus business, if there's not a distinguishing in the type of account that's created? Because we could look at this problem and say, well, those people that were cheating the system before are just going to continue to cheat the system again, right? They're just going to open up personal accounts instead of business accounts, which, again, we don't want to do that. That's going to cause all sorts of issues. But what we're telling people to do is, because we don't know how this might play out, especially as those income limit or those thresholds start to get lowered, always keep documentation of stuff that you're buying and getting reimbursed for. So, for example, let's say you buy a $1,000 ticket. You're going to get an email that says, hey, you've purchased tickets to so-and-so concert, $1,000 a ticket, and then you're going to get someone that's paying you $1,000. So even if for whatever reason, Venmo sent you a 1099K for this transaction because you're over that threshold limit potentially, you could take that receipt from that ticket that you bought and say, okay, I got $1,000. The IRS wants me to call it income. I'll call it income, but I also paid $1,000 for the ticket. They wash each other out, zero profit. You're good to go. So there might be, with this new law, a special, more documentation that you need to keep on file in case that starts to play out. Now, we're not sure what that's going to look like. We're not sure how that distinguishing is going to be, but there might be some workarounds and things we want to be cognitive of there. So how can someone avoid this new IRS rule costing their business thousands? First off, have separate business and personal items so that there's no confusion. Now, this is something, as a business owner, you should be doing anyways. The IRS does not want to see commingling. The IRS does not want to see business and personal expenses being mixed together. So we should be doing this anyways, but this is just that extra push. If you're running a business, make sure business transactions are separate from your personal transactions. If you're running a business and you're getting paid via Venmo, open a business account for that business items, have a personal account for those other items. Have proper bookkeeping and records put into place so that you can help back up and support this. We also want to have a solid bookkeeping system so that when what we're reporting as sales, we know is going to match. And always do that reconciliation. At the end of the year, you're going to get a 1099K from Stripe, you're going to get a 1099K from Venmo, you're going to get a 1099K from PayPal, all these different sources that you may be processing payments through, you're going to get 1099Ks from them. We need to collect those 1099Ks, add them up, and make sure that what you're showing on your end matches that. Because there could be instances where maybe a payment processor sent you the wrong amount. They did a wrong reconciliation. Or another thing that we often see, and these are some common mistakes that we want to avoid, is that a payment processor, let's say they charge a client $1,000, but the payment processor is going to take out $60 for their fees, and they're going to send you $940 on that transaction. Well, you might report $940 on income, but the 1099K is going to show $1,000. So there might be some reconciliation that you have to put in there that says, okay, I reported $940, but I didn't factor in that expense. So I'm actually going to report $1,000 and have an expense of $60 for payment processing fees so that my sales at $1,000 that the 1099K show matches my end. So those are some mistakes that we're going to see. That's going to take some additional bookkeeping effort. You might have to bring in a bookkeeper to help make sure that you're keeping a good record of that. So those are some of the things that you want to make sure that you're doing correctly. Again, potential mistakes that we're going to see people do along the way is, first off, don't mix personal and business transactions in the same payment app account. Create separate accounts for each and clearly label them as business or personal. And don't wait until tax time to organize your records. Track your income expenses throughout the year using a worksheet or a cloud-based accounting software. There's a lot of robust software out there that can often do a lot of those reconciliations automatically for you. And don't forget to document your business expenses and keep receipts. Set up a simple, consistent system for saving all your business-related receipts, documents, expenses, all those different things so that you have that clear communication. And as this rule starts to come into play, you have clear items that can back up your expenses and back up everything. Keep record of those reconciliations, how you're recording that, into doing that again. So again, let's talk about this. Let's do a quick summary. The old rule is that payment processors would need to send you a 1099-K if you processed more than $20,000 in a year on their specific system. The new rule was moved to $600. So instead of $20,000, now it's a measly $600. There's been a lot of pushback. There's been a lot of changes to that. And so the newest announcements as of November of 2024 is that in 2024, that $20,000 moves to $5,000. In 2025, that $20,000 moves to $2,500. And in 2026, that $20,000 officially moves to $600. Now, as I talked about, all of this could change. It's been consistently changing every year. We don't know where it's going to go, but that's the most recent update that we got on this. That's what we want to think about. That's what we want to be planning for about that. Now that you know about this costly new IRS regulation, you need to understand one thing. These rule changes are just the beginning of what could impact your bottom line. You can't walk away from this video thinking that simple compliance is enough to protect your business. After reviewing thousands of tax returns since this rule was announced, we've completely uncovered something alarming. Most businesses are completely unprepared for the ripple effects of this change. The harsh reality is that traditional tax planning strategies won't shield you from these new requirements. Between documentation requirements, reporting deadlines, and compliance procedures, we found that proactive planning can mean the difference between thousands in penalties or savings. So if you're ready to fully optimize your business's tax strategy, click the link below and book an entirely free demo call with our team where we'll help you do just that. I'll see you on the next video.